traders. Todd Gordon here with New Age Wealth Advisors and founder of tradinganalysis.com. Just wanted to do a quick, I always say quick, and it's never quick. Try to be quick. Which angles do you guys like better? This way or that way? I gotta get the microphone in there. Anyways, just got done with CNBC, and we hit the quick market technicals on this really, really busy day. With CPI, they came in at 8.3%, and markets were looking for a little bit of disinflation, not deflation, disinflation, which is inflation at a lessening rate. We were at 8.1 last reading, came in at 8.3, so I was going to look at that. Markets are really getting crushed. Tech is selling off, and I was on CNBC talking about the technicals and also sort of sentiment. I just wanted to go into a little bit more detail there and kind of talk about that. Get into the charts a little bit. I know you guys like that. So let's jump in here. Let me just get the YouTube window open. Answer any questions or comments. What's going on with you guys? Miserable day, huh? I'll give you a little sneak peek of what I'm gonna say, which I don't think it's that bad. I don't, and I'll show you what I mean by that. Let me just get the YouTube window up. There it is. Okay, welcome guys. KM, can't wait to see what Todd has to say. Oh boy. Well, let's jump in. God, it's hot in here. All right, so CPI sold off hard. I'm going to get into the charts. Let me just pull the report up here quickly and look at what we have. Okay, so let's flip this over. So this is from the BLS, Bureau of Labor Statistics, released today on the 13th. And as it says here, rose 8.1% in August on a seasonally adjusted basis prior, and then we went to 8.3. Okay, and then the big ones were, we knew gasoline had come off. We know housing is coming off. We know rents are going up because no one wants to sell, right? And the big increases we saw were in shelter, which again is rent, food, okay, and medical care were the largest contributors to the broad-based monthly of all items, okay? All right, so the core, which is less food and energy, rose 0.6% in August, larger increase than in July. Again, shelter, medical care, household furnishings, operatings, new vehicles, insurance, Tesla's going to blow that one out of the water, motor vehicle insurance, and education. So let's just kind of look through here. So breaking the CPI down, we went from 1.1 to a 0.8% increase there in food. At-home food, so that increase, and people are eating at home more so. Actually, I might take that one back, because one of the things we'll talk about is consumer discretionary sector has been quite strong, and as you break down into the industry level, there's actually some, a lot of the going out and doing things, restaurants, hotels, other industries within consumer discretionary have actually been quite strong. So maybe I should walk that back. Food away from home right here. Okay, so I think people are starting to go out more, and the industries within consumer discretionary which are going out, which are autos and auto parts and travel stocks and hotels and leisure. Those are the sectors that are leading it, and industries that are leading right now. So maybe I'm not all that surprised to see that one, food away from home, go up, where the food at home has decreased. Energy, 5% drop right there. Energy commodities, 10%. Gas, right there. Energy services were up quite a bit. So utilities, 1.5, and that's a 7% swing, minus 3.6 to 3.5 on nat gas. And if you look at nat gas, I can bring that guy over. We're off the highs. Here I can just pop this chart up quickly. There's a nat gas chart. So we sort of double topped up here around the 10. Natural gas sold off and is kind of rallying back, and looks to be a corrective rally for me. So we can kind of leave that one where you think. So just going through this here quickly, and then we'll jump into the technicals. Chicago, wonder who that is. So that's that. So new vehicles actually increased their touch. That's interesting. Not huge. Used car decreased at a lesser rate from minus 0.4 to minus 0.1. Apparel went up. Medical, not so bad. Shelter 0.5 to 0.7. And then transportation, it's, I don't know. I don't know, guys. This doesn't scare me that much. And let me round this conversation out of what happened as a result of this report. Let me just go back over here and I'll pull over the Fed Fund futures expectations. So it's going to be fundamental to CME right there. The only thing that really happened as a result of this is the terminal Fed funds rate went from 4 up to about 4.25 to 4.25. So we're coming up on the next Fed meeting, which is going to be September 21st, so about a week from now. And if you look at the percent changes, okay, from yesterday to today, our current Fed funds rate is 2.25 to current rate is 2.25 to 2.5. So what are the chances we go 70 basis points? It was 91, and then we dropped down to 68. So 75 basis points was reduced, and we went from a no chance of 100% yesterday to a 1/3 chance of 100 basis points in September. Okay, so we're either going from 2.25 at the lower rate, let's just talk the lower rate, to 3 or 3.25. Okay, so then we got to September, so we're either at 3 or 3.25 as the lower Fed funds rate. Okay, then from 3 to 3.25, we dropped pretty significantly to only go 3.5, which would have been maybe a 25 to 50 basis point increase, and we increased from 14% to 50%, 3.75, and then all of a sudden we got up to 4 to 4.25, which is now the new terminal Fed funds rate in the November meeting. And then December we get up to 4.2 to 400 to 4.25. And basically what we're arriving at is there's another 25 basis points that have been added on to the terminal Fed funds rate. Okay, I think the market was settling at 4 to 4.25. Now we're looking at 4.25 to 4.5. Okay, then if you get out to December, we're still 4.25 to 4.5. So all I'm saying is terminal Fed funds where the market is expecting the Fed to stop raising rates was 4 to 4.25. Now we're 4.25 to 4.5. 25 basis points. Okay, it's the end of the world. I don't know. We'll see. Market is certainly reacting like that. Okay, so let's get off. Oh, shoot, I wasn't showing my screen. Sorry about that. I wasn't showing my screen on that one. But I think you were kind of hearing what I was saying on that. All right. So let's get into some of the charts that I was looking at. Mr. Montilio, what's going on, bud? I know that name. Used to work on Wall Street with this man. Yeah, miserable day for sure. Okay. So let's look in. So these are the charts that I sent my producers on CNBC. I was just on Power Lunch with Tyler Matheson and Courtney Reagan, and I'm like, look, okay, let's kind of step back. Let me pull the S&P first, and then I'm going to jump into the Nasdaq. I'm always a technical guy. I run an RIA. We've got. We take a fundamental and a technical approach, but at the heart, guys, I'm always a technician just to step back, especially in days like today where, the proverbial excrement's hitting the fan. Nasdaq's down 5.5%. The Dow's down 4%. S&P's down 4.3%. Bitcoin's down 10%. So it's always good to step back and say, hold on. What's actually happening at the hard red edge of the chart? This is the S&P 500 from 2009. And the S&P has been rallying, as you can see. There's the 2017, 18, 19, when the Fed started raising rates. Trump was slapping tariffs on China. Trump was threatening Powell's life, seems like every day. And then we broke higher. Then COVID hit, sold down, rallied up. And if you look at what we've done, so the COVID sell-off is 35%. We rallied back very sharply as the Fed put all sorts of stimulus into the economy to fight off the pandemic. And I captured this chart at probably 1 or 2 this afternoon. This is one of those times where you guys, everyone just do this. The market's closed, just do this. Deep breath. The market is off 17% from the all-time highs. You have, everything that's going on right now. You have 4-decade high in inflation. You've got geopolitical tensions, which, by the way, Ukraine seems to be gaining the upper hand from the reports we're getting, which, certainly hope the case, but you never know. We've got a dismal political environment. We have all sorts of issues right here. Fed is really caught trying to stave off inflation and jacking the federal funds up very sharply, but yet the S&P is only off 17%. We're up about 80%, 81% from the COVID lows, and from the global financial crisis lows, where Rob and I worked together on Wall Street, we're up like 495%. So the market's off 17%. With everything that's going on, that right there should give you pause and say, okay, the way my friends on CNBC and everyone that I work with are kind of behaving and communicating with you, you think we're down 40%. We're down 17%. Let me go over the NASDAQ. This is the weekly chart of the NASDAQ from the credit crisis lows. 2 areas of support as I see it. And again, looking at this is, I think, sort of reassuring. There's 18-19 volatility. There's COVID. We rallied up, and this is the sell-off. Right now, I think the NASDAQ is down about 34% high to low. If you look at the bounce that we have now, we're about 28% from the high to the low. The rally, though, I don't have that stat on the top of my head. I could probably do it quickly. What do you guys think from the GFC lows, from the global financial crisis lows? How much do you think the NASDAQ 100 is up? And I'll calculate this real quick. Throw in your guesses here. I'm just doing this off screen. Whoa. 1,070% from the lows. It's unbelievable where we've come. Okay, so the way I see it, there's 2 areas of support from a technical point of view. This is the weekly chart, so you could look at this. You can look at the 200 period moving average, but why not be cool? Why not be slick? There's roughly 48 business weeks in a year. So if you do 48 times 4 is 192. So you do basically the 4-year moving average, presidential cycle average. And you could see that that's really been the line in the sand. The 192, 200 weeks, close enough. We held perfectly in the COVID lows. We held again, coming back up, perhaps going for another shot at it. And then below that, you have uptrend support, sourced from the 09 lows to the 2020 lows. And that support, depending on the angle of approach or descent, is about 10,500. So you've got the 192 moving average at 12,025. Uptrend support at 10,005. I think that's worst case support. That's my long-term outlook. Near term, as we get over to the daily chart, and this is the other chart that I send into producers, this is the daily. Okay, so this has been the sell-off. Okay, so from the end of 21, this has been the sell-off. We rallied up, and I kind of call this my ski jump pattern. You go down the ramp, you launch, kind of go back for another check. So it was resistance, it becomes support, and the backside of channel resistance that becomes support is right around 11,700. Then if you pull your fib out, you do a retracement from the July low, actually it's June low, up. The 61% retracement is at 11.9, and then the retracement of last resort, which is the 78%, is at 11.5. So you have 11.9, 11.7 channel, and 11.5/6 support on the daily. I think this is a very key zone of support right here. If this doesn't hold, then we're going to have to look to the weekly supports down around 10.5. Okay, down to 10.5, and that dotted blue line is the support. So I think the way I'm positioning it, support's going to be found here or here. Okay. Let me see if I can pull over. Oh, I don't have it launched right now, but that's okay. Everyone that I'm listening to, my friends on CBC, let me go over here, be more dramatic. Everyone I'm talking to, everyone I see on CBC is talking about being overweight energy. And listen, I'm pretty significantly overweight energy in our portfolios. I've been a lot more overweight, but I have reduced my overweight nature. And I'll show you what the weightings are here. I was like 3x overweight energy, and I brought it back in the growth portfolio. So let me just pull this little guy over. I had it open, but then everything kind of crashed on me. Okay. So these are my weightings, and this is the growth portfolio. And the energy right here, I have in the growth portfolio, I have a 7.25% allocation. Relative to the NASDAQ, that's a 7.25% overweight, because I benchmark the growth to the NASDAQ. NASDAQ doesn't have any energy exposure. So it's significantly overweight, but I also reduced it by 5%. I was at like 12.25%, which is a huge overweight in energy. I increased technology, and this is back in July, at the end of July, and I'm about to do another rebalance. I'm still a little bit underweight compared to the NASDAQ in terms of tech allocation. I'm at 43.25%. Relative to the NASDAQ, I'm 8.5% light, because the NASDAQ's got about a 51% allocation to tech. So the big moves that I made last adjustment were an increase in tech, an increase in consumer discretionary, and communications. And this is what I wanted to show you. Everyone has been gushing about energy as I've listened to CNBC all day, and on a quantitative model, energy on a week-over-week benchmark to the S&P, energy is not the strongest sector in here. It continues to be technology and consumer discretionary, because the growth trade has rotated into favor relative to value. Today is certainly going to do a little damage to that, but you're talking about a development that's happened over the last month or two. And I don't think, as I opened up this live stream, that the terminal Fed funds going from 4.25, 4.25, 4.5 is going to derail that. I don't think so. And we went through that CPI report. I was like, okay. Shelter, I think we all know that's coming off. Rents up. Food, that looked a little odd to me. Utilities, insurance, car insurance. Like, Elon's going to disrupt that whole industry anyway. So I don't know. I am not overly concerned. I hate seeing a 5.5% down day in the NASDAQ, but guys, this feels to me like a continuation of a thin summer move. August tends to be a very thin trading month where moves get very exaggerated, and it feels like, and you can't read too much into them because the volumes are very low. The senior traders are off the desk. It feels like it's kind of carrying through into this. And I've got a couple examples of this. If you look at the macro market situation, all right, so let me show you NASDAQ over Treasuries. NASDAQ over the Treasuries. Let me get rid of this. So this is NDX, 1 year chart. NDX is in white, and this is the actual price of the Treasuries. 30-year Treasury bond, 2-year Treasury, okay? This isn't the yield. So the bonds are going down, yields are going up, and that's what's really driving this market, okay? Yields going up because the Fed is going to push federal funds on the short end of the curve higher, and 30-year, longer end of the curve, the Fed sort of nudges along. It doesn't have such a direct impact. But what you'll see here is the NASDAQ is significantly off the lows. And let me get the time scale in here. So that's July, that's the July low. NASDAQ's off the low, well off the low, but the treasuries are trying to push to new lows, which means interest rates are going to new high. Sentiment is extremely bearish in the stock market right now. But treasuries, I think, are being pushed around a little bit. And by extension, the dollar, which the dollar has been very strong because of this development. As our bond prices go down, the yields that can be earned on deposit, international investors selling their currencies to buy the local dollar to just earn 3.5% on a 2-year treasury, that dynamic is being pushed forward because Europe's got an energy crisis. We've got geopolitical issues. China, who knows what they're doing? I mean, you don't want to be investing there. It's just the fact that our yields are superior to the rest of the world right now. Europe's got issues. They're trying to raise rates. The economies are nowhere near as strong as ours are. So I really think it's a carry trade situation that we saw back in 2008 or 9, where the rest of the world's selling their currency to buy dollar, to buy our treasuries, buy our fixed income instruments, and I think also buy our stock market. So if you look at the dollar, same situation. Again, higher yields brings more dollar flows to us. And if I bring that dollar chart over, same situation. So this is back to, oh shoot. Let's get that out of here. Oh, sorry. Where'd my dollar chart go? Let me pop that up again. Okay. So this chart goes back to, wow, June of 20, Jan of 20, March of 20, May, there's 21. Let me get this guy behind him out. It's a little confusing. Okay, so here's the NASDAQ in white. And again, this is 21, there's 22, this is this year. So this right here is a little confusing, but those of you who have foreign exchange experience will be helpful. This is the chart of the US dollar, but it's inverted. Hi, buddy. The kids are home from school. I love that the kids are home. I love the kids are home from school, but I love that they're at school. I'll be going back out in an office soon. I came home during COVID. It's been great working home, but it's time to go back to an office. Anyways, this is a dollar chart. This is a chart of the US dollar, but it's been inverted. Okay, so as this line is going down, the dollar is getting stronger. And as you see over on this scale, the numbers are getting bigger. The dollar is getting stronger. Basically, that will hurt multinational earnings. Companies that have that do a lot of overseas business, when they bring those earnings back and they have to convert them back into dollars, they get less money for those earnings. So that's why there's an inverse relationship between the dollar and the stock market. And I think the move is being exacerbated again because international investors, I think, are selling their local currency to buy our dollars, to buy, oh God, oh, I've blown up that dollar chart twice as soon as I was really bringing it home for you, to buy our US stock market. Okay, so what you see is the dollar's getting stronger here in May, June, all summer, but the NASDAQ has not followed suit. The NASDAQ should be making a new low as the dollar is making new highs. And again, this chart is upside down. This green chart is upside down. Okay, so you have treasuries making new lows. You have the dollar making new highs. Bond yields making new highs, but the stock markets are not confirming with such bearish sentiment in the stock market. And everyone's saying the inflation trade is here. And I listen to all my friends saying energy is where you want to be. I'm overweight energy, as I showed you, but I cut it by half. And in my tactical dividend portfolio that I run at New Age Wealth, we're equal weight in energy right now. So could be early, could be wrong, but I don't think so. I don't think so. One of my favorite charts just continues to be Tesla. I mean, you look at this thing, as I mentioned, consumer discretionary is very strong. And again, the market's selling off because we've got such hot inflation. Everyone is calling for the death of the consumer, but yet if you just put your shut your brains off and look at what's actually happening in the markets. It's very important to know what's going on from a fundamental point of view, but you've got to compartmentalize that and then look what's actually happening in the market. Why is consumer discretionary and technology the strongest sectors on a week-over-week basis relative to the benchmark S&P? The energy market, the energy XLE is trying to come on back, but it's not happened. Okay, we're seeing a rotation into growth, and specifically it's those consumer-sensitive industries within consumer discretionary like auto, parts, auto stores, auto manufacturers, hotels, what else? I have a list over here somewhere. Restaurants, lodging, travel services. I mentioned auto stocks like lodging, leisure. These are the strongest industries, and it just doesn't square up with the bearish sentiment we're hearing and people telling us to get back in energy because inflation's here. That's not what's happening in the market. And I think the market is what's happening on the hard red edge of the chart, I think should take precedent against what you think is happening and what everyone's trying to scare you into feeling. Anyways, Tesla, you look at what's going on with, Tesla in terms of an auto stock within consumer discretionary. That's the flagship consumer discretionary. Some would argue a tech stock. I certainly would. In this chart right here, this is the price chart of Tesla going back to, pretty much a year, November 21. This is October run up in 21 in Tesla. This happens to be the largest holding in our growth portfolio. And I'm fine with it. Absolutely fine with it. So this chart down here, this is a ratio, Tesla and the S&P. As much as Elon is taking it in the teeth for his shenanigans in Twitter, which I say good for him, look at Tesla relative to the S&P 500. Tesla is stronger than the broader market since June. What? Tesla is stronger than the S&P 500. S&P 500 is stronger than the NASDAQ. So Tesla's certainly stronger than the NASDAQ. So you look at this, we moved up, down, kind of broke through some resistance. Resistance becomes support. Just draw some parallel lines in there. Real simple. Algorithmic traders, quant traders, tech guys will certainly have this breakout level about 345 in Tesla. If this somehow can get a bid from 290 to 345, we're going to new highs. I firmly believe that. And that is not what people are talking about right now. I listen to everyone all day telling me to get long energy. With crude oil, $30 off the all-time high. I don't see it. I don't see it. Anyways, Tesla from a fundamental point of view, I look at their quarters. They're from a fundamental point of view, their deliveries of vehicles. So they delivered last quarter, Q2, 255,000 vehicles. 255. Let me write this out for you. Tesla delivered, and you can't hold me for spelling here, 255K vehicles. They did it on $2.5 billion in revenue, and they had a profit margin, GPM, gross profit margin of about 30.1%. $2.5 billion in revenue on a 30% margin, 255,000 vehicles delivered. Ford delivered 456K vehicles, made $668 million net rev, and they had a profit margin, gross profit margin of 9%. Their revenues, I don't remember their revenues offhand, but they were significantly higher. They're higher than Tesla. Their profit margin is 1/3 of Tesla. They delivered half the cars. Ford made $668 million in net revenue. Tesla made $2.5 billion. And that's when they're dealing with Shanghai shutdown. They're bringing Texas, the Austin Gigafactory online. Obviously, inflationary pressures and supply chain issues like all the other car dealers are dealing with. But, I mean, they're making more money on 3x the margins that the traditional automakers are, and I hold Ford. I like Ford. I like what they're doing. They're trying to be a competitor to Tesla, but I think when you look at everything that's happening with Starlink, how they're hooking up with T-Mobile, they were talking to Apple in order to get SpaceX into our phones with satellite, because I think 5G coverage is a failure. I mean, 5G, I don't know what it does. I mean, the range is horrible. We'd have to have a 5G tower every corner in order to get continuous high-speed coverage. And my big thesis is once Elon hooks the Tesla fleet, whether individual passenger vehicles or taxi, or mass taxi, individual taxi with Starlink, game over for the autonomous driving race. That's the race he is on. All the other traditional automakers are still trying to fight, just get an electric battery and secure a supply chain and electric battery into their cars. He's past that. He's fighting the autonomous vehicle game. And when he hooks that up, and he made a tweet saying Tesla will be connected to Starlink. He's got, I don't know, 2,000 or 3,000 satellites in space. FCC's permissioned him for like 40,000. Amazon's trying to do it. I forgot the name of their project. The FCC's permissioned them for like 2,000 total. They didn't even launch their 2 betas into space yet. So it's just a different game. It's a different game. Anyways, I don't want to come off sounding like a big cheerleader. If we do start to break through 11 and 10.5 in the NASDAQ, I will look to hedge. I will look to protect. I do have about 8% cash in the growth portfolio, and we have used inverse ETFs for our clients, and we will do so. But I'm continuing to stay bullish. I'm trying to set the noise aside right now. Hope that helps. Let me know what you think in the comments. If you have any questions, things you'd like to see me cover. Thanks for listening, guys, and